Well, while we're waiting for the slides to get started, I've always called my field market microstructure, which is the study of how markets work at the level of individual transactions, but it's closely related to Fintech. So when I came up with this title because I really didn't know exactly what I wanted to say, and I figured this was a general enough title that I could say anything I wanted to. But here we are. I got interested in market microstructure from talking to my father when I was a university student, and my father actually, I think, invented electronic trading. He devised a system in the early 1980s for farmers in Texas to sell cotton that they grew on their fields to merchants anywhere in the world, and implemented it with what they called IBM 360 computers, which are these big computers that look like refrigerators but had minimal processing power by today's standards. And they also implemented a system of electronic warehouse receipts so that the cotton actually was given a digital form, and it was actually transacted digitally with a kind of delivery versus payment, clearing and settlement at the end. They did that in the early 1980s, and I wondered why financial markets for financial assets like stocks or bonds or foreign currencies didn't do the same earlier. And so this is one of the topics I will address in my talk. So my outline here is to provide some general comments on Fintech, and then to provide a specific discussion related to securities trading, and kind of forecast what I think the wave of the future is going to be. In the process of doing this and having this discussion, I want to talk about two pieces of research that I have conducted that I think of as related to market microstructure, but really are also related to Fintech and tie in to my discussion. I'm right now a professor at the University of Maryland, where I've been for a long time. Many people in Europe don't appreciate where the University of Maryland is located. It's located maybe 15 kilometers from the White House, so it's a short commute from Washington. It's essentially located in Washington, D.C., in a very nearby suburb of Washington. So all of the finance professors at the University of Maryland are kind of constantly watching what's going on with financial regulation in Washington. Well, technological trends will, certainly affect Fintech. And when I think of the technological trends that are important, I think of three things. Number one, the fixed cost of executing a transaction has fallen. We heard earlier about transactions costs going down, but it's really this fixed cost that has gone down. And so what that allows you to do, if you want to, is make a lot more transactions than you used to be able to do. In the past, securities transactions or futures market transactions were negotiated over the phone or in person, written down on pencil and paper, checked on pencil and paper, cleared and settled with pencil and paper even. And that has a certain fixed cost for any transaction. And it encouraged traders to use block trades. And a block trade is defined as let's call it a large-size transaction. One of the reasons for doing large-size transaction is that it was cheaper to negotiate in a way that made sure that there weren't mistakes. If you had thousands of trades to go through every day by hand, the cost of checking and avoiding mistakes is very high. Second of all, a second trend with Fintech is that physical location is less important. The communications technology has improved so much that the communicating even across all around the world is very fast. And then the third trend that I associate with this is encryption. And encryption allows lots of things to take place, but it allows verifiability with greater anonymity and privacy at the same time. But another trend that I think of has to do with extending the rule of law. So it seems like even though there's the potential for creating a huge amount of decentralization, ultimately you need some kind of rule of law. And one reason you need it is that reversing errors requires a legal system so that you can go after people. Richard may disagree with me a little bit on that. And you need to be able to investigate things to verify that an error was actually made. And finally, monitoring of markets is something that's going to be an issue related to fintech in the future, and that's going to require access to information. That's going to potentially reduce confidentiality, and as we heard earlier, this can incentivize the government to want to use fintech to actually collect more information than it would have collected in the past. So you've got these two different trends running against each other, one favoring decentralization, the other favoring kind of rule of law or greater government monitoring, which may or may not be connected with the rule of law at all. Okay, so where does fintech play its role? These low transaction costs benefit traders who want to make small transactions. So what immediately comes to mind would be individuals, maybe poor individuals in third world countries who have a cell phone. They may want to make small cash transactions among themselves. But what my talk is more related to is the opposite end of that spectrum, and that's a gigantic trader. Let's imagine an asset management company that wants to buy millions of dollars worth or hundreds of thousands of shares of stock in a particular company, or potentially wants to trade large quantities of foreign exchange, tens of millions of dollars. What fintech allows to happen there is it allows the big block trades that traders used to execute to be broken down into very small pieces and executed piecemeal over time. And we've certainly seen that that has actually happened. If you look at the average size of a transaction, say on the New York Stock Exchange, you'll see that it's declined by a gigantic amount since the 1990s, maybe by a factor of 10 or 20. I can't remember the exact number, although I do have a paper on this that I'm not talking about today. It's declined by a huge amount, and that's clearly related, in my opinion, not only to the fact that fintech reduces the costs of subdividing these large block trades into small transactions, but also, given the low cost, people still want to do that. They want to subdivide. So we'll want to talk about why they want to subdivide. Well, fintech has the potential to create huge gains, but why might these gains not occur? Like, why didn't electronic trading get implemented in the stock market in the 1980s? Why was it implemented in cotton cotton markets and not in the stock market or even the futures market? And I think the answer is largely lack of competition. So it's lack of competition in the banking system, lack of competition among exchanges. I just put the banking system here. Lack of competition in markets generally. That's one reason. Another reason is taxes and regulations. I know in the case of my father, they designed this nice spot market for cotton. They got it working perfectly. Then they designed a futures market for cotton, and they went and presented it to the Commodity Futures Trading Commission, which is the regulator of futures markets, and then hit a brick wall because the costs of regulatory compliance were going to make it too expensive to actually implement it. So they didn't implement their futures market at exactly that time. They implemented only a cash market. And then there are technological barriers that also prevent fintech from gaining a lot of traction in a lot of markets. And one of the big technological barriers that people alluded to in earlier talks but didn't go into detail on, I think we should explicitly point out, and that's barriers to a kind of identification and authentication. So, for example, in a payment system, one of the important things is to know who's making the payment and make sure that there's not some kind of fraud going on or someone hasn't stolen somebody's account. So I think for small payments among individuals, even the operators of the cell phone companies or the operators, the companies that own the operating systems that these things operate on, they have a kind of natural role to play in these markets because they probably are in a better position to do things related to authentication. But I'm going to take the discussion in a different direction and talk about my area, which is market microstructure, and talk about competition and market power and securities tradings. Well, both dealer markets and organized exchanges have historically exercised monopoly power. But they've done it in kind of different ways. If you look at, I'll look at the second bullet point, organized exchanges first. The New York Stock Exchange started in the 1700s with an agreement to fix prices. And the idea was to extract commissions that were above the competitive level. And one way to do that was to put everybody in one place so that you could monitor what they were doing and make sure they weren't cheating on the structure of fixed commissions. And that system lasted from the 1700s into the 1970s before it was kind of deemed to be in violation of antitrust laws. But what allowed the exchanges to kind of get away with it for so long, in one respect, was that their network externalities. There's kind of a natural monopoly associated with being an exchange, and that natural monopoly comes from the network externalities that exist and are especially powerful when communication costs are kind of high, and that allows trading to congregate in one place, which would be in the United States. It would have been on Wall Street. So exchanges carried out their business model, but the business model was based on extracting a fee or extracting a cost from every transaction that was above the competitive level. And even though the fixed commissions were deemed illegal in the 1970s, the system carried on into the 1990s, up to about the year 2000, by transferring the monopoly power from the brokers who charged the fixed commissions to the exchange itself, which had specialist system and so forth with special powers that the specialist had that allowed them to, in my opinion, earn monopoly profits. So the second bullet point, which is the first one up there, is looking at what dealers do. Well, what dealers do is they tend to organize markets to benefit dealers, but that means benefit the dealers at the expense of their customers. And the key feature that I think defines a dealer market is that customers have a great difficulty transacting directly with other customers. So what a customer would like to do is post a limit order to buy or to sell, and then have a dealer, or have a broker really, show that order to the entire market. And then if a customer of another broker somewhere else sees that bid or that offer, and they want to hit that bid or lift that offer, they can do so, and then you have essentially an agency trade where one customer trades with another customer, and it's intermediated by a couple of brokers. Well, what that does is that allows customers to compete with dealers. If the dealer's bid is down here and the dealer offer price is up here, and the dealer's the bid-ask spread measures a kind of profit to the dealer. There's some costs, of course, that come out of that. The dealers like that wide spread, but this inability of customers to submit limit orders that other customers hit prevents customers from submitting a limit order at, say, the midpoint, and then have another customer come in and hit that order at the midpoint, essentially depriving the dealers of the ability to earn that bid-ask spread. So this is essentially the way all dealer markets have operated, and dealers have historically gone to great lengths to try to prevent customers from coming in and undercutting them. The NASDAQ settlement of the 1990s, I actually worked for the Justice Department on that case. The NASDAQ settlement required NASDAQ to post customer orders in a manner that other customers could hit, and I thought that would make the market more competitive. And certainly the settlement that the government got implemented that idea, and markets did become more competitive after that, but this carried us into the 2000s. And so it was a couple hundred years after the New York Stock Exchange was set up and many decades after NASDAQ became active in the 1970s. Okay. And all these systems have inefficiencies, but the dealer markets also have used a kind of antiquated, costly human technologies, which are kind of part of the system for preventing the customers from trading with customers. The organized exchanges shared rents by keeping human trading for a long time, even after it kind of was unnecessary. They kept a specialist system of the human being. Trades would go into a computer, come out of the computer at the specialist desk, go back into the computer. So the specialist was there as a human being, introducing an inefficiency, but maybe making a profit as a result of the way that system operated. Now, what's happened recently, and by recently I mean the last 20 years, is that you've gotten regulation NMS and MiFID in Europe, and what those regulations have done is kind of broken the monopoly power of the organized exchanges, and also broken the dealer market by allowing exchanges to compete with one another and allowing customers to place orders kind of anywhere. And the result of that is that the costs of trading for customers have dropped enormously, but the potential gains from internalizing network externalities have been, to some extent, maybe not completely dissipated, because there are huge numbers of messages flowing around the systems to arbitrage one exchange against another. And so my conclusion is that organized exchanges are potentially an economically efficient way to organize transactions, but they require a better mechanism. They require some mechanism, maybe better than MiFID and better than regulation in MS, to prevent the exploitation of monopoly power while allowing gains from network externalities to actually occur. So I had a couple of slides here that are not related to the rest of my talk, but I think it's something to point out, and that is that as the trading mechanism has changed, going from organized exchanges to dealer markets, what's kind of quietly happened in the background is that trading has become more anonymous, not less anonymous. In a dealer market, the dealer knows who they're trading with. They know their customer, and they can actually price discriminate if they want to, or try to price discriminate by charging some customers higher prices than others. And we know, for example, in the corporate bond market, small customers trading small quantities wind up incurring larger bid-ask spreads than large customers trading large quantities. And that's inconsistent with many of our theories of market making based on adverse selection or private information, which suggests the spread should be wider for the better informed, bigger customers. And the reason for it clearly is monopoly power that the dealers are exploiting over their smaller customers. If you look in organized exchanges, it used to be the case that when human beings would trade, they, of course, saw each other, so you knew the broker or the floor broker, but you would also exchange information about the clearing firm. And so the information about who the brokers were that were trading and information about what the clearing firms were was kind of quasi-public information. Anybody standing there watching the trading could get on a telephone and tell their customers in New York exactly which brokers, at least, were buying and which ones were selling, even if the identity of the customer was kept secret. But you go to a fully electronic market, which is what we have now, there's more anonymity because it's not necessarily the case that when a trade is matched, the buyer and the seller have any idea of who they're trading with. So it led to, in the old days, market makers would watch other market makers, and they would probably all be buying and all be selling at the same time because they were following similar strategies. Okay. So my conclusion here is electronic markets have made things more anonymous than they were in the past. And it raises some issues of intellectual property that I'm not going to address that have to do with what can exchanges do with the confidential information that they actually have as part of the clearing process. Okay, I want to skip ahead and talk about my current research. But before I do, the exchanges have evolved differently. The stock market largely has these very tiny transactions that I'm going to talk about in a minute. Corporate bond markets, foreign currency markets, and markets for treasuries still have dealers who are fairly powerful in those markets. Their power is being eroded by new competitors coming in that basically you might call Fintech competitors. But their power in the stock market, I think, has been largely eroded. And so we can see kind of a reasonably competitive system in the stock market now. So I want to skip ahead and talk about two trends in my research. And I'm going to talk about two papers, both of which have been published. One of them is a paper called Smooth Trading with Overconfidence and Market Power. It's a theoretical model in the area of market microstructure. And what it does is it motivates explains why traders who could do giant block trades, and in fact would want to do a giant block trade if they were allowed to, nevertheless split their trades up into very small pieces and essentially trade continuously over time. So what that paper does is it sets up trading as a game among traders who exercise monopoly power. And in this case, exercising monopoly power means that the traders are aware of their price impact and they don't want to incur large price impact costs. But the way the game works, and this is not a property that's assumed exogenously, it's a property that the game kind of intrinsically generates. The way the game works is that the faster a trader trades a large quantity, the more temporary price impact they will have. So if you want to buy 100,000 shares of stock and you do it in 5 minutes, you might drive the price up by $1. But if you do it in 5 days, you might drive the price up by 5 cents. And so if you want to conserve money by minimizing your price impact, you will stretch your trading out over time. And so in this equilibrium, all of the traders provide liquidity to the other traders by taking the opposite side of their trades. But every trader trades gradually, even though they would like to trade really, really fast. And a good measure of the liquidity of the market is a measure of how gradually traders trade. In a liquid market, traders can trade very fast. As the market liquidity increases more and more and more, traders trade faster and faster and faster, and then you might say that the market looks rather competitive. It's not really competitive, but it looks rather competitive. In an illiquid market, the trading stretches out over a long period of time. And one thing that the paper shows is that the speed with which the market operates, while it on the one hand indicates how liquid the market is, it also indicates how much information is coming into the market. So if traders are acquiring a lot of information, that actually makes them trade faster. It makes liquidity go up, which is what makes them trade faster, and it makes them happy to do that. So the practical implication of this paper is that traders trade gradually over time. They break their trades down into tiny little pieces, and that's what they want to do as a natural part of the equilibrium. Okay, now let's look for... I want to talk about another paper, and then I'll be done. And this paper is essentially a policy proposal called Toward a Fully Continuous Exchange with Zhongmin Li. I'm fortunate to have 3 co-authors who know a lot of mathematics. I feel like I'm getting old. I used to know a lot of mathematics, but I'm getting old now, so they can do it more quickly than I can. But the idea of this paper is let's take the way traders want to trade and implement directly how they want to trade. So this is how traders trade in today's markets. You trade in units typically of 100 shares. Those are the dots there. We have dots for buying that represent buying, dots that represent selling, and you're required to trade in units of 100 shares. In addition to that, you're required to trade in increments of exactly 1 cent per share, 1/100th of a dollar. So there's a lot of discreteness that's forced on traders. So if you force this discreteness onto traders, how do they trade if they really would like to trade continuously in the smallest possible increments? And the answer is they will trade exactly 100 shares at a time, and they will trade in the even pennies, and the prices will move around 1 penny at a time, sometimes bouncing up and down between the pennies. But in the current system, what this does is it generates a huge flow of orders, because to execute one 100-share trade, if you're a high-frequency trader, you might have to place and cancel 9 orders in order to get the 10th order to execute. So there are huge numbers of messages that come into the market for trading very small quantities, and this is what dissipates a lot of the gains that you could have from network externalities. So what do we propose to do about that? Well, we propose making the trade markets continuous. And I'm going to show you how making it continuous kind of works, and then I'm going to talk about its benefits relative to high-frequency trading. So let me show you how our proposal works, and then I'll maybe backtrack and show a few other things, and then I'll be done. So the way we think markets should work is that traders should be able to trade as flows. Rather than trade 100 shares at a time, maybe you trade nano shares, a billionth of a share at a time, but essentially that's a small enough quantity that you can think of it as a flow. And so you may want to trade 1 share per second, let's say, but that would be 1 millishare, 1/1000th of a share every millisecond, and that you could trade that way. And so you submit supply and demand schedules where we put the price on the horizontal axis and the shares on the vertical axis. Could have gone the other way. But if you look at the vertical axis, it's shares traded per second. It's not number of shares you want to trade. It's the speed with which you are trading whatever the number of shares is that you intend to ultimately trade. And then on the horizontal axis, we have prices, and we allow the traders to place piecewise linear schedules to buy and to sell that are essentially supply and demand schedules. For implementation ease, we require that the kinks in the schedules be even pennies. But the intersection of supply and demand can be a fraction of a penny. In this case, it's $41.24.6. And the total volume in the market might represent the trading by many different traders, and it's a flow. In this case, it's 20.8 shares per second that are being transacted, but it might be 100 different traders, 50 on the buy side and 50 on the sell side, transacting that. So this is our proposal, and let me backtrack and explain what it does. High-frequency traders in today's markets, let's see. I can't find the slide. High-frequency traders in today's markets make their money in a variety of different ways. One of the ways they make their money is by hitting stale bids and offers. Another way they make their money is by canceling orders before they're about to be hit. And what our proposal does is it makes the amount of money at stake in that game of speed very minimal. So instead of being able to make $1 or a few dollars by hitting somebody's stale order quickly, or save losing a couple of dollars by canceling a trade quickly, you may be able to gain a fraction of a penny. So it may be hundreds or thousands of times less money that you're able to make by trading like this. And so our proposal is to use Fintech, which is the idea that individual trades can be negotiated at very, very low cost, to allow traders to trade in a manner that's the natural equilibrium of the game that they're playing. That was the first paper I talked about. And one way to do that is to just let traders trade as flows. That's the second paper that I've talked about. And we think that as a side benefit from doing that, you will eliminate profits that high-frequency traders are able to make simply from the arms race that Bootish, Crampton, and Shem talk about in a paper on frequent batch auctions. So we think our idea is like a frequent batch auctions idea. It's quite similar to their idea. It's compatible with their idea, and indeed we're working with them on a paper that would kind of combine the two ideas into one. So the bottom line of this, I'll skip to the conclusion, is that we propose this fully continuous exchange to make quantities continuous functions of price, and also make them differentiable functions of time. And we think this would make trading much more efficient and capitalizing on the gains that we get from the low transactions costs made possible by Fintech.